Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
They don't sometimes conflict a little bit. From a fundamental perspective, bottom up, when you're looking at earnings, how much you're paying for earnings, and the market is way overvalued, right? Particularly when interest rates are this high, it doesn't make any sense. Like the multiples are too high in consideration of where we see the earnings. And in fact, we're looking at earnings as seeing like a slowdown, if anything. And so that makes it really difficult from a bottom up fundamental perspective to get excited about the stock market. If anything, it would be telling you to sell it. And so that's sort of the one part. But the other side of the market is it has very little to do with fundamentals, but has everything to do about supply and demand. And it's like where you're not really buying companies, you're buying the market, you're buying the asset of equities. And that is driven by supply and demand dynamics, which are actually quite favorable for the stock market because you have very limited supply. There's no IPOs right now, just maybe there's a little, but not a lot. There's continued share buybacks, which, keeps the supply of equity down. And of course, very importantly, there's massive demand coming from mostly retail, right? And that demand is not just guys, retail just buying single stocks or ETFs. They're using options, they're buying triple beta ETFs. It's unbelievable how much retail flow has come into the market, which is a bit scary when that happens because it elevates obviously multiples, and there's no consideration really of the fundamentals or the risks or anything like that. It's just get me in, it's blind money, and it's a lot of the ETF flows are huge. So, but this does happen, and you can't kind of dismiss it, right? And it can stay for a while. So the way we kind of look at it, or at least I'm looking at it, is clearly we're worried about where this could end up because at some point the fundamentals will matter. They always do. It always has to revert back to the actual fundamental. But when does that happen, and what will cause this sort of supply to demand dynamic to change, where we go back to the fundamentals, which would most likely be would be a correction to reset the market at a more justifiable price. So there's two, I guess, really simply, there's sort of two things that can change it. One, which we've seen in the past, is the supply of equity really starts to pick up. And that's, you do go into a big IPO, almost more frenzied market like we did in 21 recently. All the SPACs start to come out and all this shit, all this low quality stuff starts to get IPO'd. And that, saw that 99, 2000, like that's a kind of classic end when you get that kind of excess supply. And then insiders are typically selling into that as well. And so and corporates stop buying back stocks. That's a possibility. That would get us really freaked. That got us really freaked out in 21 when we started seeing all these SPACs stuff coming out. There's, oh yeah, that's like a classic end. But I don't know if that's going to happen or not. But the other side of it would be the demand. Something freaks out the demand, which is basically the demand from retail. And that's probably, to me, is the more likely risk. And that what we watch very closely is what would get retail really worried. And the one thing is, for sure, would be if we started to see a big pickup in unemployment, where retail investors, it's hard for retail to keep buying stocks if they're about to lose their job, right? And that would be a real risk, or a big uptick in inflation, which I do believe is a risk, particularly as we start to go into the fall, as the CPI and the tariffs and all that stuff will start to work its way in. In fact, I would argue it just started this last month. We had an uptick. We get another uptick, a couple more, that could start to become a problem. We get a big move up in 10-year bond yields as a result of which, or Trump just does something idiotic, fires Powell, or does some crazy tariff shit that kind of freaks everybody out. But this is the hard part, is the market, when you're in this sort of supply demand market, the market always goes, it doesn't look forward. It doesn't discount risk. It goes right up to the end. And that's why when these things happen, it's not just a gradual decline, it's a crash potentially, right? We did that in 87, we did that in 99, it goes down hard. So that's the tricky part. because you don't want to quite get out, but there's this risk. So if we see any signs of like inflation picking up, or we get really poor jobs numbers, which we haven't really seen yet, that would get us more reason to become more cautious, and we'd start to really try to pull back some of our beta right now. But right now we're kind of still in it. So having said all that, like it's all, we're in this kind of weird zone where we don't like the market, we don't like the fundamentals, and our bottom up and stuff saying like we should be selling it. But then there's this sort of top, I don't know, what do you want to call it, supply demand dynamic that makes us still kind of stay in it. So a lot depends on, your risk tolerance on that part. So what we try to do in the meantime, this has been a big part of how I invest in equities, is I get very thematic and look at secular trends. Because to me, it's like, well, I don't know. This is hard to call, hard to time. But I feel if I'm at least I'm in a secular trend, and even if there is a correction, I feel confident enough that these secular trends will, because they're secular, should still prevail. These are the stocks that are, they could go down, but they'll come back because of their underlying, secular tailwinds. And so that's kind of where we try to keep a focus on. So we have these sort of like silos of where we put our money. And I'll tell you what I think they are. They're pretty obvious. The AI obviously is a huge secular theme, but it's becoming extraordinarily expensive. Let's not kid ourselves. I still like the AI infrastructure, not so much the AI application, because I don't know where that's going to go. So I still like NVIDIA and the NVIDIA-like type stocks, like could be Broadcom, like Celestica. They're very expensive and they're very susceptible to a down move, but I do feel they still have this tailwind behind them. And what we also then like with that is probably more so almost is the infrastructure to support AI and the build out of AI through data centers. And takes us into the industrials and the electrification trade. Like that has been a really good big theme for us, and it's been really good. And I still don't see that going away. The demand, like we just see these big companies, like Google just announced how much they're going to spend and so on. That these are names like the Eatons, the Quanta Services, Siemens Energy. We saw GE Vernova just like crush it yesterday. We like that power infrastructure trade. That also taking into utilities, things like that, electrification. To us, that is a very strong. I just don't see how that ends. Because it's not just AI, right? There's electrification vehicles in crypto. This is all power consumption. And we do feel over time, right? There's going to be more electrification, less fossil fuel. Natural gas, though, we still like because it has to be it's an important part of that electrification. So we'll take natural gas is still a pretty good place to be. And then there's some other ones, but the other secular theme. So this is all AI related though, right? So, and we saw, if market starts to freak out about AI, like it did back with DeepSeek, the whole thing goes down. It's very correlated, right? So so what's really also important is what you think about, okay, what's a secular theme that's not AI? And there's two I look at, which we like. We still like the defense sector a lot, and particularly European defense. So we've done really well there. Rheinmetall. There's a really good Canadian ETF we like called Shield, SHLD, which has all the European. It's just pure defense stocks, a lot of European in there, plus some of the in the US. So we still like the defense theme because defense spending is going to continue to go, particularly in Europe, for a long time. I was just with the Morgan Stanley aerospace defense team who were out of Europe, and the numbers they throw out are just like, wow, like the amount of spend that has to occur. So we like that. And then the other one, and this is the one that I'm quite still very bullish on, is one of the most obvious secular themes is debt and how much debt there is. And going to continue to, like with Trump and everything, deficit spending is out of control. It's massive. What does that do? What benefits from that? This is one of the reasons the market's going up because of all the debt, like basically, creating all this liquidity, if you will. You're inflating asset prices in some respect. Gold, that's a secular theme with all the debt. You have to own gold. Maybe Bitcoin, maybe crypto too could fall into that. This is not going away. A secular theme that I'm very confident in is these, like particularly now with Trump and this stupid bill he passed. It is so much. It's going to increase the deficit so much. The amount of debt issuance and so on is going to undermine, U.S. dollar asset value, because basically what happens is if you're priced in U.S. dollars, your value goes down and so on. So gold is in my view, is in a secular theme. It's not surprising, to me that gold is going to new highs as the market's going to new highs. That's just kind of that's the debt that's sort of feeding all this liquidity into these assets. But I think as they both go up, I think there's a real chance the equity market, for all these reasons, could get smoked, particularly if you start to see inflation and so on, which I think will happen. That gold will sort of retake the lead, if you will. And so you have to own gold, in my opinion, and things that can benefit. There's some funny other ways of playing it, like debt, which is a lot of debt. Well, you like guys that do debt rating agencies, like Moody's or something like that, or SPGI, or not as, yeah, S&P. So that's kind of the other big thing for us. We like gold. I think it's a great diversifier, and I think it's going a lot higher over the next little while. That's a theme that I'm trying to think of other ways of playing the amount of debt that's in the system. But gold to me seems to be the biggest, most obvious beneficiary. You got to get secular themes that are non-AI, and that's defense and gold, in my opinion. And that's sort of what I got. I'm open if you guys have any questions.
Anybody?
Sure. Thanks for the opportunity, Dave. Chris, I wonder if we could bat around something. Buffett
Sure.
has this ratio of market valuation to GDP, and most people look at it in the sense of, oh, well, the market value is way too high, way too high. What about looking at it the other way, that GDP may come up to the market value? Do you think there's any merit in that view?
Yeah, like it could, inflation, particularly in nominal terms, right? With higher inflation, GDP will go higher. I'm not as optimistic on the GDP in the US economy. I think the US economy is actually deteriorating underneath. The consumer if you think about it, the US economy would be in the dumps if it was for AI and all the money that's being spent on AI infrastructure. That's where all the spending is. That's where all the CapEx is. The consumers, in my opinion, which is 70% of the US economy, is not in a great, it's not a contraction, but they're not really growing. And so I struggle with that. I think the one thing is, the economy and the stock market don't necessarily jive. Like they could diverge a little bit because the stock market is not representative of the economy. That's why small caps aren't doing particularly well and so on. I don't see a lot of breadth right now in the market. I think it's very top heavy. Well, it is. Crazy. Nvidia is now 8% of the S&P 500. Like, it's very top heavy. So I don't. That would be the hope that the U.S. I guess the economy really starts to pick up, and there's all this productivity gains and all that. But I am not convinced the consumer, what you really need, is in a position to drive the economy higher. There's some major secular problems with the U.S. economy, and a big one is immigration. There's no immigration. In fact, it's the opposite, right? They're deporting everybody. If you don't have population growth, it's really hard to grow the economy. So unless you get some incredible, like 90s productivity improvement, which you could, but that's going to take so long. Because I don't think AI is it just doesn't just happen overnight. So I'm not sure the U.S. economy is as strong. It's going to go up. I just think asset prices have already been inflated.
Yeah, I guess I was looking at the commentary around the Trump's bill and the spending that's going to kick in if it does hit the road. I mean, we saw Biden's infrastructure never really hit the pavement, so to speak. On your point about inflation and immigration, I've seen some pretty good commentary that's pretty inflationary because services, large component is wages, and you remove the bottom, the bottom tier, that's going to put pressure up on wages.
That's right. It's a cost. Like I'm worried that U.S. Corporate margins are going to start to really get compressed here because of the costs of wages, the costs, like all these tariffs and this weak dollar. Like, this is all very inflationary from a U.S. perspective, and that's why I think inflation is maybe the biggest risk out there that market's not really pricing in. And we'll probably see it from the bond market first, I would think, because the bond market at the long end should start to show. That's why we watch that 10-year really closely. If it breaks through 4.5, if it goes to 5, that's a big sell signal, in my opinion. So that's what I think is out there, is this sort of inflationary impulse is going to really start to pick up, because the numbers you can really see how it's all sort of like with coming into the fall, like the CPI is going to start to pick up. The tariffs are going to start to show up. and the lack of and wages and so on are going to start to kick in, and I think you could start to see some surprisingly high numbers. And that's something that we're sort of focused on. But I don't think the U.S. economy is going to have and the thing too about the bill, it's about tax cuts, which mostly to the wealthy. That doesn't necessarily go like re-stimulate the economy necessarily. A lot of people just buy more stocks with the tax.
Right.
Like they don't like necessarily invest in the economy. They invest in other assets, like stocks.
Right.
Yeah,
So
like it's not like when Biden was giving checks out to everybody where it actually gets spent. Like it is stimulant, but maybe not as much.
right. It sounds
You,
like you're not believing that tariffs could be, we're hearing that word being tossed around by Fed officials, transitory.
I think it actually. I think companies will start to raise their prices. The U.S. companies are not going to. They will push their prices higher. They're not going to suck it all up, and I think you're going to see higher prices.
Yeah, we've all seen price gouging at the retail level, and the companies take every opportunity, even if they're not
I
affected
know.
by tariffs.
I don't know about you guys, but like when I go to the US, I'm always shocked at how expensive stuff is compared to here. Like just when you go to the grocery store or whatever. Like I just go like this isn't I don't know. Like US corporations they are very much about they will push prices higher or they'll shrink their products one way or the other. Yeah, I think I think there's way more inflation than what what the data is showing us. The other thing too, just one thing I throw out as well, which is just sort of on this whole what we're seeing in the market and how much money is going into equities and so on. One of the things too that is when you think about assets and what do people invest in, where do they put their money? I can tell you one of the things that's interesting to me at least is that we're not seeing the housing market is pretty shitty. People aren't buying new houses. So if you're not buying a new house, which is a huge capital outlay for people and all the money you have to spend associated with the house and so on, and appliances and whatnot. If you're holding back because these people aren't buying houses because of the affordability, but what are they doing with their money? They're buying stocks, they're buying memes. It's going into the equity market. And it's interesting to go back in time and you look at equity markets that go way up. Housing is usually pretty weak under housing starts they aren't usually that good. And that's why those are the two biggest assets, right? Equities and real estate. Like of course there's bonds, but those are the two that kind of move and they kind of move counter to one another, right? An equity bubble and crash will lead to a real estate recovery in a bubble, and then that crash will then lead to an equity bubble. Like they go back and forth. And so the weakness in real estate to me is which is more is leading to equities going higher. And that's why the economy isn't, you look at what's going on in US housing underneath and go, wow, that looks really bad. But yet your stocks going higher and higher. It's actually one's feeding the other, but it has nothing to do with the fundamentals. You know what I mean? It's just that it's an asset rotation. And so that's sort of part of my theory is that what's happening right now, which is a little worrisome because we've seen this before, right? And it doesn't end well for equities. It's just the problem. I just don't know when is that going to happen. But I'm getting nervous. I think it could be soon. I think it's going to be this year sometime before the end of the year. See something. Maybe it's like this could be. I don't know. It's really hard to say this is like this period or this period. It's always a little bit different, but there are some similarities with 87, weak dollar, market was obviously way up, very expensive. There's inflation though, where interest rates started going up, right, in 87, October, okay, like that sort of, there are some similarities there, but yeah, and there's a lot of debt, right? That's when Reagan was like spending so on. So yeah, we'll see. You got to get some protection in here, I think, right? Which for us is gold. And then some other, we don't mind buying certain sectors that like I like utilities because they play into the power theme, but yet they're not stupid expensive compared to the market. So we like that as a sort of an area that we kind of feel it's a defensive secular area. Can't buy consumer staples, really hard. Can't buy healthcare's messed up with Trump and everything they're doing down there. So it's kind of a bit of a scarcity. Okay, where do I go? Where do I go? Well, utilities. You kind of win in that sense.
Okay, that's great, Chris. Anybody have anything else they want to bounce off, Chris? Well, just one additional footnote. Record amount of cash sitting on the sidelines in the U.S. at something like $7.4 trillion. So That's going to chase this market up. People are earning 2 to 4% on that money, and when they see the market roaring higher, they're gonna chase that.
Yeah, when CNBC starts talking about record highs,
Yeah.
which we're gonna start. That's why it could go higher
Yeah.
before it goes lower, which is why we're in that kind of this. We don't like it, but we know why it's doing it, which isn't sustainable. But that's why we're not willing to sort of like bail on the market, and that's why we're still buying, owning what we feel are the big sort of secular themes, which is AI is sort of obviously the top of the list.
Yeah, exactly.
The one thing that I would be keeping an eye on, though, where I'm getting more and more nervous, though, is obviously the market's very tech heavy. I think the U.S. is getting close to S&P is getting close to 50% tech. Like it's a weight. NVIDIA, as I mentioned, is 8%. Microsoft's 7%. I do worry a little bit about, and we're actually pulling back a little bit, is on the big hyperscalers because of the spend that they are having to put up, like the Metas. And as an example, like we love Meta. I hate Meta, like I hate the company, but the stock, right? But I just, the amount of money they're spending on everything, like, I just worry about they won't be able to generate enough profitability out of AI. So their margins are going to be at risk here. And so that's kind of so that's why I'd rather buy, if they're spending this much money, okay, who's benefiting from that spend? Well, it's going to be NVIDIA, it's going to be Taiwan Semiconductor, Broadcom, the data center guys that are building the stuff, power generation. That's right. I kind of rather be there right now.
Excellent. Okay, anybody else? Well, hang around if you like, Chris. Ken's going to give an update on the valuations of the market, and then I'll follow up with some similar stuff. Gilbert will be covering off what SAC sees in the market, and then hopefully we'll hear from others after that. So, Ken, take it away.
Just show the disclaimer for anyone we send this over to after. It'll be pretty quick. There weren't a lot of changes on these. It just continues to kind of echo the same points that Chris was talking about. Just a continuous push higher, I guess, basically off that bottom. Really no pullbacks. You can see 2 here back in April, but nonetheless, S&P now up about 8% year to date after being down almost, I think, 10. So quite the 3 month change. Really heavy demands, which kind of coincides with what Chris was talking about on the technical side. Overbought, oversold at 90%. That's the highest, I think, of this year, and the longest streak of above 70% since early 24. So you're really seeing the demand being pushed in and chasing those returns at these what seem now like daily all-time highs. Same thing with the NASDAQ. The technicals in these growth indices really showing some strength now, obviously being led by AI. Overbought, oversold 81%, really elevated. And it's really been heavily overbought since the start of May. So going on basically 3 full months of being above 40%, which is kind of unheard of for an overall indice. So really getting that demand. And then here, Dow, not as much, obviously, in terms of a pop or all-time highs. You can see the resistance lines above. Has created some short-term support, which is a positive note, but overbought, oversold, still very elevated, 77%. That's the highest in a month. Now it's been overbought 12 weeks in a row. So despite the kind of lag of the Dow compared to the S&P and the NASDAQ recent months, seems like everything large and mega cap is being overbought pretty heavily right now. TSX 60 here, $2 increase week over week. Continues its melt up off the bottom. I mean, this chart's even more telling than the US ones because there literally hasn't been a pullback since April. Obviously, there's been continued inflows north of the border. Commodity prices have moved up pretty strongly, especially recently with copper, even silver and platinum. I think platinum had the best month in June. It had its best month in decades, increasing pretty substantially. Obviously, there's no deal between Canada and the US, so we'll have to see if anything comes. At least there's been some deals, I guess, being announced. We'll see if any more are announced in the coming days. But you can see here, overbought, oversold, 88%. It's the highest since October 2024. It's been heavily overbought over the last 8 weeks. So you're seeing this massive demand, and it's not just in North America. It's obviously across Europe and in select emerging markets as well. This is the VIX. Crap, I copied the wrong photo. Anyways, it's the lowest the VIX at the lowest level since the tariff threats were announced by Trump with those Bristol boards on the White House lawns. We're at a 15% VIX level, which is pretty, I guess, surprising with everything that's going on. But it seems like market participants are kind of brushing everything off and, as we said, continuing to buy basically every dip if there is any. These are the bullish percentage charts, kind of just talk about breadth here. Obviously, with small caps lagging, you see the difference between the S&P and the NYSE, but then obviously there's a couple select sectors within the S&P that are lagging where their components are not trading in bullish patterns, just like these 2% positive trend, which are a little more lagging, but nonetheless really displays the strength right now of tech, and then especially some of the largest companies in the world all trending in bullish patterns that are positive trends. I'll just flip through these two pretty quickly. Actually, the percent a positive trend for the TSX sitting at 54%. That's a 2.5-year high. So really got a breakout this week. So something to watch there. And then these asset class rankings, not a whole lot of changes here. Kind of a flip-flop here. We know real estate obviously has been struggling recently. And then down here in commodities, energy and agriculture has pulled back a little more in the last week and a half. Whereas precious metals, unsurprisingly, picked up those, I guess, lost buy signals within the commodity area, especially with the price of, like I said, silver and platinum performing pretty well recently. I mean, with markets at all-time highs, and it seems like there's a lot of liquidity right now in terms of retail. We're kind of in this meme, back to the meme, I guess, like the GameStop. I mean, GameStop created some Bitcoin treasury. It seems like a lot of companies are adding crypto onto their balance sheets to try and attract some crypto-focused traditional investors. So I don't know how that's going to end up. But you can see these 4 companies surging from about 50% to 305% in the matter of a month as of yesterday's midday, I think, screen grab was I saw in a newsletter, but I mean, these companies aren't increasing for any fundamental reason. They're just based on the similar characteristics of GameStop in past cycles. Just highlighting here, the US dollar, it's down 10% year to date still, despite increasing off that bottom earlier this month. Price target points to a higher price, so we'll have to watch that there. But you can see the real breakdown, the 4 straight sell signals. It's important to note in 22, the US dollar did create 6 straight sell signals. We'll have to watch that. And it is important, even more important to know this DXY index was at a lower point in 22. So it's not like this has never happened in the last 10 years. This is just a chart Dorsey Wright tracks, just a lot of data they comb through. It just looking at the number of 6 consecutive positive trading days, obviously in a row. It's rallied about 1.9% as of would have been Tuesday's close in the past 6 trading days, placing the recent occurrence obviously in the bottom deciles. Data goes all the way back to 1972, but really they're highlighting the lack of occurrences of this trend, 6 consecutive days. And you can see the numbers, I think, are the total numbers, I think, just around 200. So over the course of almost 50 years, excuse me, just over 50 years, really rare there. This is a semiconductor ETF. Dorsey Wright highlighted this week. Obviously, this is kind of skewed towards some of the big names that we all know, but really just actually got up to its high this week, breaking through that resistance level that it created in January before the massive sell-off. But you can see the huge return down from about all the way in the mid 150s to 275. That's almost a 100%, close to probably an 80-ish% return in the matter of, I don't know, 12 to 14 weeks. That pure turnaround really being driven by retail investors. And I think the fear of missing out really is catching some retail to continue to pile in. This is just a chart that Dorsey Wright highlighted. It's from obviously the FOMC, just the target rate probabilities. As of yesterday, there's a 55% chance there would be a 25%, 25 basis point rate cut at the September Fed meeting. About a week ago, that number was closer to 65. So kind of fluctuating in that 55 to 65 range over the last month. So we'll have to see what happens, especially as it seems like Trump and Bessent and all of their cronies, I guess, continue to kind of take shots at Powell. This is an interesting chart that I saw in a newsletter, just tracking the price of a Rolex GMT Sprite. You can see that I don't know watches very well, but nonetheless found it to be a very interesting chart. Obviously, the price of some assets boomed in 21 and early 2022, kind of coinciding with that meme stocks back, even some of those like Artcoin, like the really tumultuous cryptocurrencies, but very interesting that the price of a Rolex has collapsed by almost like 67% in the matter of 3 years, just displaying kind of the lack of affordability that I guess Americans and even Canadians are seeing in their everyday lives. They don't have that extra liquidity. Here's Platinum Trust. I mentioned the price of platinum. We own this across a bunch of accounts. We were buying it basically most of last year. Really happy with the performance this year, 57% up year to date. Price target 135. What we've read on the platinum front is that there is a high potential for a continued increase, especially kind of with the catch up that platinum could have with its multi-year consolidation relative to gold. Kind of a similar story with silver. So we've kind of diversified our precious metal exposure there rather than just owning gold. This is the Canadian Energy ETF. We own a couple of Canadian energy names that we held on to after selling most of our US names in the oil space. We don't own this ETF, but kind of a proxy. Decent performance here for some large Canadian energy producers, especially in the gas area. I think Peyto and a number of other companies have really had strong numbers come out on a quarterly basis. We think that'll continue. Obviously, with the pullback in the price of U.S. natural gas this week, there could be some bumpiness to that, but obviously in the long term, that's where our focus is. And I think that's the last slide. So I'll toss it over to you, Dave.
Thanks, Ken. I'm now moving along to Michael Coolbaugh, and I'll try to go through these charts the best I can. So options volumes here, this might come to answer your question as well, Chris Dutton, but option volumes are just reaching a historical high right now. So there's just a lot of money chasing risk assets like this. It could be retail. It's hard to tell, but that's an incredible trend since it's at 2011, I think, is the far left.
Yeah, and I've seen that chart. There's a lot of leverage.
So much. Derivatives are a real problem. Okay, the fiscal horror show. Into Michael Coolbaugh's slide deck here. Each recession since 2000 has seen a deficit rebound get lower and lower. COVID let the toothpaste out of the tube. We're near record low unemployment and an economy growing 2 to 3%. Yet we're running greater than 6% fiscal deficits. Gold futures. And just so everybody knows, Michael Coolbaugh is a quant analyst in the U.S., and the U.S. doesn't often talk about gold. It's almost anti-American to have gold in your portfolio down there, whereas you're starting to notice more and more Americans, commentators talking about it. One way to judge the strength of the trend is how does it respond to extreme overbought? Does it correct with a sharp crash or through space and time? Gold became wildly overbought and has been consolidating through time, usually the sign of a strong trend. Okay. Gold seasonality, gold futures seasonality. So gold perking up after its recent consolidation and now has a very strong seasonal tailwind. I always remember that August is one of the strongest months typically for gold, with all the buying going on the retail side, especially for the Indian weddings. Yeah, so that's a very important seasonal trend there. The CRB raw index, industrials. Inflation is dead, and we need to cut interest rates by 3% immediately. Welp. The CRB raw industrials index suggests commodity inflation is making another run after a large 2 to 3 year base. So Yeah, I think that first part was a bit of a spoof maybe on Trump, and he's anti-Trump, this analyst, that's for sure. But yeah, I personally don't think inflation has been beat yet. Trouble with the data. Yes, inflation numbers have been well behaved. Only problem is, can we trust the data? And now approximately 35% of CPI prices are being inputted from other items because of data collection issues. Yeah, I'm going to try to get John Williams on a call. And John Williams, as you know, is a guy that he's a longtime economist, and he actually shows inflation and some other government data on he actually monitors it himself. He just doesn't trust the government data. And he always shows like a 4 to 6% higher number than what the government shows. And he can back it up too with data, his own proper data. Here goes platinum again, major breakout, said that palladium and platinum are somewhat interchangeable. Oh, here's that slide again, just a blow up of it for the options. The casino floor, as it said, Sailor's Ponzi diagram. Yeah, this MicroStrategy by Michael Saylor, that's just incredible. What is this showing us here? I don't know. It's just that he's got a lot of Bitcoin. Explaining the Ponzi in broad daylight. So what's this doing here? Decrease it at a dividend rate. I'm not sure what he's saying here, but just know that if you buy MicroStrategy, you're basically paying 2 to 3 times the price of Bitcoin, but it's performed that much better. A lot of money chasing it. The utilities popping on our radar. We have a number of signals fire across the utility sector over the past week. Aside from this breakout, other names include a bunch of names there. So money going to safety and of utilities. And that's it for Coolba. Let me move on to finally on Dorsey Wright, and then I'll pass it over to you, Go, in your slides. So this Canadian dollar continues to trickle higher at 74 cents. Still, the vertical price objectives are still mixed here. The short-term indicator shows it going up to 80, and the long-term still holds it back to lower levels of 62. So we'll have to see what happens there. Yeah. We've already covered the US dollar enough, but there it is at 97, and it does measure up still. So it's actually going to be probably doing a little sideways pattern now until it gets a direction. And once again, these tariffs are fully baked into the system, and that might still take quite a bit of time. Oil looks like it's toppy right here, measuring down. Same thing as nat gas, same thing as the producers. And copper looks like it's sort of leveled out. Uranium still has lots of legs, with probably being the best energy source for nuclear, and with all the demands, as Chris was pointing out earlier, with AI, etc. Gold, yeah, gold still looks higher, both on the futures up to 3570 and on the spot of over 3500, as do the gold bug index. Van Eck quite a bit higher. So there's going to be more and more money chasing these now when it becomes apparent. I think the average American has something like a 1% weighting in gold in their portfolio. So that obviously shows you that many people have zero, and that could change. The juniors look strong. We've got one junior right now called Oh My Holdings that continues to just perform spectacularly, creating a little bit of a challenge for us and how to time our exit. But yeah, that's been a fortunate one that we've landed on in many of our riskier accounts. Silver at 40 measures up to 47.50. Silver's got some catching up to do to gold now. There's going to be money chasing that, and same thing for the producers, and the juniors all look like they're going higher. Platinum now looks like it's topping out here. Yeah, Bitcoin measures over 200,000 now from the 118 that it's at. Ethereum with this new bill in the US, it's another catchy name, sorry, I can't remember it, but a lot of the money through these altcoins use Ethereum as the base to the production of those. And here you see Ethereum looks like it's a double here based on its upside. I was hoping that Sean Cumby was going to join us today. I'm going to get him in the future to sit in on this, and we're going to have sort of a part of a macro session when it comes to the crypto space. It can't be ignored. We have some in our client portfolios right now in the alt program, but we'll probably be adding to that. Okay, let's finish up here with interest rates. Before I do, though, actually, It's always good to look at the Canadian banks. They're looking stronger now. Haven't said that in a while, but 47 for this equal weight of them, measuring up to 67.50. Yeah, we'll have to keep an eye on that. And finally, interest rates. So the short end at 2 years at 3.8% measures down to 2.8. So that's going to be pushed down sooner or later. Either the Fed will do it or the market will do it. Same thing as the 5-year measures down, the 10-year measures down, and the 30-year measures big up from 5% where it is now to over 6%. So you've got a steepening of the yield curve. Maybe we'll hear from Chris Curry more about that at the end. And so that's it for that. Ken's gone through the rest of that. I just wanted to show just what the valuations are looking like right now of the various indices, and everything's green for the year to date around the world. The venture exchange in Canada is the leader out of all of these other major exchanges, and so it should be. It's a huge laggard when you look at the 10-year. Got a lot of catching up to do, as does China. And so the S&P is catching up. The Dow is a little bit of a laggard, being more of a value index and less technology than, as was pointed out, the S&P 500 being almost 50% in technology now. It's crazy between the NASDAQ and that index. And the big leader in Europe looks to be Germany and Italy. And that's about it for those. Wanted to look at those pricings, and I've already talked about these pricings. I've done it backwards today, but that's fine. Okay, that's it for me. Gilbert, I'll get your slides up on the screen here, and you can take it away.
Yeah, thanks, Dave. There's really not much to discuss this week. What we're really looking at is the MB ratios coming right back up to their previous highs. That's what it looks like. S&P 500, you can see that band there was resistance back before the tariff decline, and we're getting really close to it once again. So that's the S&P 500. If you go to the next slide too, the NASDAQ, sort of the same thing, right? We're in a situation where this band, the HB1 price, which has been resistance before in 2022, and also last summer and earlier this year, we're getting close to it again. So that looks to be indicating that valuations are pretty stretched here, and we are going to act accordingly. I would say that the main thing that we're looking at right now is really the fact that valuations are once again stretched and are back at that same price to book valuation level that saw resistance many times before. Russ was also talking about PE valuations. You can see they're very stretched here. So yeah, it's a tough market.
Good stuff. Chris Curry, do you want to cover anything?
Not today, Dave. I had a great session with Chris Dutton, so appreciate that.
Okay, good. Paul Beatty, what's going on in your world?
Yeah, morning, guys. Well, I mean, I wanted to bring out one alarming statistic for you guys in the cannabis space. We met with the CEO of Village Farms. You guys, I don't know if you ever saw that company, but anyway, they delisted from Canada. They're only listed in the US. They are now the largest cannabis player in Canada, right? They are the winner in that whole industry battle of growing and distributing weed. And so here you have it. They have a market cap. So the largest player in Canada, they're EBITDA positive, cash flow positive now. They have a market cap of $150 million. Okay. And they generate next year estimated to be 50 million in EBITDA. So it's trading at about 3 times forecasted EBITDA. Most of their profits are coming from Europe. So they're a good sized player in Europe, and they're the largest in Canada. And yet their market cap is down to 150 million. You remember when Canopy had a market cap alone of 12 billion, and Aurora another 10 billion, and we used to add it all up, you'd have 50 billion in market cap just in the Canadian listed securities. And here you are 5 years later, and the number one player is down to 150 million. So just to show you that in Canada, another example of how an industry came and went through our capital markets, and the amount of volatility, just absolutely mind-boggling. The only other observation we've come to in this confusing market Have you guys looked at Deutsche Bank's share price? And here's a theory for you. You want a safe, conservative investment where you can make 3 times your money in the next 12 months. Just buy Deutsche Bank stock, because we can all love the Canadian banks and everything, but they've got healthy market caps. Deutsche Bank's enterprise value is nothing, and it's like whatever 60, maybe it's up to $70 billion now. So if you want to play Europe, you want to play Germany, you want to play value, play that they're inflating their market. Just buy Deutsche Bank stock and look at the stock chart. The thing's up 7% this morning. So I think it's actually accelerating to the upside. And so what we did is we just went out and bought long-term calls on Deutsche Bank. I think that's a very interesting play. And that's it for me.
Okay, good. Thanks for that. That looks interesting, Deutsche Bank. We'll have to look at that. It's trading very high right now, so see what happens. Anybody else? Joe's away this week, by the way, and next week, so it'll be a little quieter. And yeah, I think that's about it.
Appreciate it, guys. Have a good day.
Okay. Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.